It's great to be here, and today we're going to talk a little bit about tips for successful long-term investing. There's a lot of things you can do in markets, and I've done them all, and I've made all the mistakes you can make, and I've also found ways to do things better. So I wanted to share some of those ideas with everybody. In fact, I was on Fox this morning, and they asked me, "What do you do with your money? Do you go to cash?" And I said, "You never go to cash. I mean, that's the worst place you can go, because it doesn't grow, and in fact, not only does it not grow, but it actually gets depreciated in your pocket as if the Fed decides to print more money. So it's always good to have your money trying to work for you, and that's one of the things today is all about. I do have my own disclaimer, which you can read, because I could never read all this. I'd have a nervous breakdown. But it does talk about risk and suitable and all that other stuff. So I'll give you about 10 seconds to read it and look at it, and then we'll get started. In the meantime, while you're reading, the name Bubba just came from, how many 6'3" Jewish guys that were not born, but were playing football in the 60s. Me and Bubba Smith were brothers, so it worked out well, and that's how I got the name. All right, so let's begin here and get started. And there's a long-term solution to a short-term problem. And of course, I love cartoons, and I use them all the time in all my presentations. And I retire on Friday. I haven't saved a dime. Here's your chance to become a legend. A guy talking to his broker. And of course, a lot of us are in that position. For those of you who don't know me, now I know obviously I recognize a lot of you, and you are gluttons to be with me regularly. So I've been doing this for actually 38 years, not 36, and I'm still a member of the Chicago Board of Trade. I founded Bubba Trading. I'm the author of Bubba's Guide to Trading Options, and I have a new book coming out in October, which is basically Bubba's Guide to Trading Weekly Options. I regularly contribute to Fox, CNBC, BNN, RFD, Phoenix TV of China, and Kitco. I host my own radio show every day at libertytalk.fm, and I was an original market maker in the S&P pit, which is still going today. It's one of the only pits of the CBOE that's still live and trading with real people on there. And Annie did mention I will be in Vegas on October 1st. If you have any interest, please feel free to shoot me an email. I'll tell you the details. It'll be basically a one-day boot camp from 9 to 5, where I'll be. It'll be like going to camp for football players. We're going to make the summer camp. So we're gonna work hard and really try to teach some of the new stuff and introduce a lot of the new things in my book. In the meantime, today we're going to talk about building a portfolio, investing, derivatives, compounding, maintaining your portfolio, dividends, protection, hedging. And of course, as always, I'll take all of your questions. So, as you build your portfolio, okay, obviously we invest, and one of the things is we'll talk about later, but you only invest money that you don't need, all right? In other words, we all need money, but you don't invest the rent money, you don't invest the car payment, the house, whatever. You have to keep money that you're prepared for. One of the reasons that markets melt down and we get these major collapses because everybody forgets to keep money aside for an emergency. And of course, when does the emergency happen? When the markets are getting ready to break. And of course, you're taking years now selling, so you're fueling the fire. But we've got 401ks, we've got IRAs, and we need to learn to take advantage of those in a better way than we have in the past. There's a lot of great ways to build that tax-free or Roth money, depending on which one you have. Right, but investing is basically committing capital to an endeavor with the exception of obtaining additional income or profit. Now, what we believe in and what I believe in is I think that you should be well diversified. I'm not somebody who believes in the trying to guess the market for my long-term investments. I'm a straight, 90% or 85% equities. I don't rotate them. I don't try to find the hot sector. I sit there with what I own. I protect what I own, but I do have other assets, and I think that everybody has to have a diversified portfolio. But I don't think that you want to try to guess. You'll start to hear, well, we have risk off now, so they're starting to go to defensive stocks. I think when you try to rotate your portfolio, you create more problems than if you just stand pat and understand how to protect what you currently have. Now, investing is only money that you don't need. And again, it's just, you need to figure out yourself whatever you can afford to put away, let's say on a monthly basis. And I've just gone through this with my son. My son just took a job. He's going to work for Edward Jones. He just graduated college, but I've taught him since he was younger. I said, just whatever you can afford before you go out drinking with the boys or before you go to Starbucks or whatever you're going to do, make sure that you pay yourself first and put that money away. Okay? And whatever, if it's $20 a month or it's $200, whatever it is, you need to make that commitment. So if it means going to Starbucks 1 or 2 times less a week, or it means giving one thing up, you won't miss what you're giving up. But you'll certainly appreciate it when you have that big lump sum later in your account. And I think that's something that we forget about, because we're always saying we'll do it later. Okay, so commit to something you can live with. And it doesn't matter. It doesn't have to be a lot. It just has to be something that you're rotating into the market, into your investments every single month. And make no excuses. Now, some things you can invest in, obviously, there's treasury bills and CDs. Right now, obviously, not very exciting to put your money there, but those are investments. Fixed income securities, bonds, asset-backed securities. Look, at the end of the day, your 10-year, even at 2.2%, in 10 years you're getting 2.2%. Right? That's guaranteed by the full faith and credit. If you're not so sure about the market, wouldn't you rather be in bonds and sitting in cash and not getting anything? I'm a big believer in stocks for long-term portfolios. I'm in stocks. I don't sell them. I buy them. I let the dividends reinvest. Unless I need the money, now again, I don't need the money from there, so I continue to let those invest and compound over and over again, because that's one of the keys of long-term investing. Now, I do trade derivatives. I trade options. I use options in my long-term portfolio as well. And I do trade futures. I think that those are great alternatives to trade, but you wouldn't really be accumulating a future for a long-term investment. You'd be putting it in something that future might be derived from. Now, derivatives are they're derived from something else. If you look at a simple derivative, the S&P or the SPX, okay, that's what I started. That is the underlying security to the spiders, SPY. That is the underlying security to the E-mini S&P. Okay, so those products are derived from a main underlying. All right, grains, corn, wheat, and soybeans, those are derived. The futures contracts are derived from those. They trade natural price to price. Now you can exchange, you can use cash, you can use dates, but again, those are great products to use. Options, you're buying a right, or you're selling yourself into an obligation. But derivatives will often allow enhanced leverage. Now again, I'm not a big leverage guy, especially when it comes to your long-term portfolio. This is where many people run into big trouble in their long-term portfolios when they get over-leveraged, because again, I only point out Lehman Brothers and Bear Stearns. The reason that the financial system collapsed was not only because of the over debt, the stupid mortgages that were out, but it was the over leverage that everybody had, because they were all forced to sell. So it's something you want to be very careful with when you're dealing with leverage, especially when you're dealing in your long term and what I like to call your case money, your retirement money. Now, compounding your portfolio, Albert Einstein, the 8th wonder of the world is compound interest, basically. Now, if we all remember when you were kids, you had the kid would come in and say, hey, will you give me a penny every day and double it? And you'd be, oh, sure, that's easy to do. But what you don't realize is that it ends up to be about $5 million by the time it gets done with a month of doubling. And that is the same formula that is used in the stock market. All right? Just remember one thing. Now, right now, those of you who know me best know that I've been fairly bearish for probably a substantial amount of time. But I've also said, full disclosure, that I don't sell my long-term portfolio, number one. Number two, that the markets do go up 9% year over year. So they don't go every year that up 9%, but they do average in the history to go up 9%. So your objective is to be there to get paid when it is going up. Now, terms that you should just know, obviously we talked about investment. Risk, you got to understand what is the risk. And this goes back to, where am I? What do I have? What am I exposing? Am I going to be forced to make a bad decision? You know, if you're a poker player, if you ever watched any poker, if you ever heard any stories about Doyle Brunson, his big thing is always force a man or a woman to make a decision for all their chips. So that's why markets end up selling off, is because, again, this goes back to people are too deeply involved, they're over leveraged, they get afraid, so they dump. And that's always the big puke, which will happen again. All right. Passive investment strategy, that's just a great way. That's kind of what we talked about, the putting away monthly, making sure that you're buying good solid securities that you feel that are going to be around in 10 years. You're not looking to buy penny stocks. You're not looking to buy stuff, you know, high-flying stuff. Again, there's nothing wrong with gambling a little bit on certain things, but there's no reason to gamble with your retirement money, all right? You want to gamble, fine. I gamble all the time. I have no problem with it. But don't gamble on stuff with money that you really can't afford to gamble with. That's really what it comes back down to. And of course, it's very active. And you know, most people that are around me that work with me are a blend. We've got a passive income investment strategy, and we do some things that are very aggressive as well. So that's what we're looking for, and that's where you kind of decide where you belong with all this. But why should you invest? Well, the first thing is you want to invest because you want your retirement to be okay. You know, especially those that are younger than me, all right? Social Security's got about zero chance to be around. I give it about 10 or 15 years, unless they change something, and I doubt that they're going to do that because they want to keep getting reelected. You want to depend on yourself when it gets to retirement. You don't want to depend on anybody else. So you want your 401k, your IRA, whatever you're using for yours, okay, you want to make sure that's set up. You want to save, invest because you want to make it, maybe you want to purchase a new home. Maybe you want a vacation home. Maybe you got kids going to school. I have one more year with my last child, all right? I had two in at once, and it was $100,000 a year. And now I'm down to 50. I feel like I got a raise, and pretty soon there'll be none, all right? And that's why you want to be investing, because we need those dollars to grow. You know, no matter what you make on your job, it's really never enough. And you want to make sure that you can grow some of that money while you're sleeping. Now, when you're building a portfolio, there's all kinds of different portfolios that you can trade in. But the first thing you have to do is you have to personally assess your own risk tolerance. All right? Me, I have a very high risk tolerance, which isn't always so good. You know, it's led to some pretty big beatings, but again, that's what you have to decide is where or at what point are you going to break and be forced to do something you don't want to do. That's always the key in investing, is we do things we don't want to do, but because of fear, we do them. So that's where you have to assess what kind of risk you're willing to take. Consider your asset allocation. You know, do you want to be in stocks? Do you want to be in some options? Do you want to be in some futures? Do you want to be in gold? All right. I mean, I believe that, you know, all portfolios should have a little bit of representation of gold. And believe it or not, I'm going to also say that all portfolios should have a little bit of representation of some of these cryptocurrencies now. Because I do believe that those are going to be, one of them is going to be, I believe, a real currency. Not that they're not real now, but one's going to be part of it. And a lot of the advisors that I know some billion-dollar advisors that I talk to all the time, and they're starting to buy some of these cryptocurrencies. And again, I would never buy too much of it. Again, you have to remember, whatever you're going to buy there, figure it's going to be worth half in 6 months. Make sure you can understand and assess that risk that you're willing to take. Develop a plan to take a long-term view. You know, where do you want to be? What are you looking at? Diversify your portfolio, and that comes with an asterisk, although I didn't put one here, because if you learn to hedge your portfolio, then you can actually trade you can put all your money in one stock if you wanted to, if it was liquid and you wanted to hedge it. But diversify through different industries. You know, buy a little financials, buy a little tech, whatever. Don't overload on one. Don't get trapped into what everybody else is doing, because the public is always wrong. Now, they're not wrong today, but they will be wrong because they'll always be proved wrong over time. Figure out what your investment time frame is. All right? Do you want to be active? All right. Now, day trading is not something I ever recommend. I do some part-time day trading with people. I teach that, but we're not looking to be in front of a screen 9 hours or 8 hours a day. You know, true day traders, you eat at your desk, you don't do anything. You trade, and there isn't that the business does not lend itself to be that exciting anymore to do that. Right? But again, figure out what your time frame is. Is your horizon, do you want to look at monthly charts? Do you want to look at weekly charts? Do you want to look at daily charts? Those are things you decide because they'll help you make those decisions. Determining the proper amount that you're going to allocate, and do you want to be conservative versus aggressive? And again, there's a whole model in between. You can do a lot of different things, and a lot depends on your age. It depends on your financial status and what you're looking to do. And you know, many are looking to build for their children and their grandchildren. So, sell the losers, let the winners ride. That's something that we always believe. Don't chase a hot tip. Nobody knows anything. Okay, there's a few insiders, but you're not getting the information. Okay, listen, Martha Stewart went to jail. She was sitting with the chairman of the board of the company, and he got her out. She went to jail, and the stock went up 50 times. So that's what I'm trying to tell you. Don't try to chase the hot tips. In today's world of technology, in today's world of information flow, there is no hot tips. Now, back when I first started, there was a few because the information didn't flow as fast. You know, those of you that are old enough to remember the Cuban Missile Crisis, that was around for like a week before anybody knew about it. Today, it would be out in 2 minutes. Everybody would know about it. So remember, don't chase it. Okay, don't sweat the small stuff. If you're gonna be invested, be invested. They're not going up every day. All right, they have gone up every day recently, but again, they're not going up every day. Don't overemphasize price to earnings. You know, fundamental trading is a waste. Okay. Now, I'm not saying that the company shouldn't be strong fundamentally. Let's not confuse the issue. But look for strong companies, but buy on technical reasons. Okay. And I always use the example of Apple. I believe it was 2011. I can't remember. You know, I'm getting so old, I can't remember. But I was on Bloomberg TV, and that was when Apple had the special ticker. It was $700 a share, and they were going crazy, and it's on the moon. And they came out at that time with the biggest single earnings quarter of any company in history, hugely profitable. And Adam Johnson came to me and said, "What do you think?" I said, "Sell it. That's it. They've oversaturated for now. It's not that I don't like Apple. It's not that I don't think it's a good company, but it's due to have a little bit of a sell-off." And as it turned out, Apple sold off about 50%, and now is back and higher than it was then. That's why you want to look for technical reasons to get in. Identify companies that are strong competitive advantages. You know, you can't go wrong buying like an AT&T or something like Microsoft. Those are companies that are going to be around forever. Apple, I mean, those are going to be companies that are going to be around. You want something that's going to be here 10 years from now. Be sure that the competitive advantages will last. Now, you know, IBM, Big Blue, used to be the big leader. They fell way behind the times, and their stock is way down. So what we need to do is make sure we find the ones that are not going to be what actually Microsoft at one time turned into, but they've reevaluated and turned themselves around, and now they're at all-time highs. These are things you want to hold for the long run. Now, principles for successful long-term investing. Plan on living a long time. All right? Harness the power of dividends and compounding, which simply means that you want to allow the stocks that you're buying to have the dividends go in the DRIP program, dividend reinvesting program. You want to keep the money in. You want to let it compound and compound. Again, we don't want to take money out unless it's an absolute emergency, because the secret is that if you compound it, it grows much faster. Avoid emotional biases by sticking to a plan. And we talk about putting together a trading plan, because you need to have a plan for every type of style that you're going to trade. All right. Now, I have a plan for my long-term investing, and I have a plan for my daily futures investing and all the other things I do. But each plan is different. You don't want to get confused with trading and investing. They're not the same. They shouldn't be treated the same, and don't ever confuse an investment with a trade and vice versa. But many people, they buy something that they want to really invest in, and it happens to do really well quickly, so they dump it and take the money. And of course, they had something else that they had bought, they had planned to have for a trade, but of course it went against them, and so they held that for an investment. It became a dog. It doesn't work that way. It's not good to do that. So make sure you're paying attention to those things. To stay invested is what matters. And again, as I've said, I'm bearish the market right now, but still, I've been bearish, let's say, for 500 S&P points, or 1,000, whatever. It doesn't matter. The point is that I didn't get out because I can't pick the top, I can't pick the bottom. I can give you the probability, but by staying invested, everything that I had kept compounding and compounding. That's all I'm looking to. I didn't get hurt in this whole thing being a short part of it, because my long-term portfolio is simply that. It's a separate entity. It's a business on the side. Being diversified never hurts you. Do your research. Now, what is your research? It doesn't mean sit in the library and read a book. It means you find something you like, look around, see if it's viable, if it's going to last. Amazon, back in 08, and before that, people didn't think Amazon was going to last. Right? Well, look at it now. So there's a lot of things that go on that you have to look and make some decisions on. Run the stars and sell the dogs. And all that means is, when you get a stock that doesn't look as good as it when you bought it, it's not doing what you expected to do. Get rid of it, buy another one. Reinvest the dividends. Take the long view. Don't be afraid to be contrarian. All right? Again, if you look, you will find that the public, the retail, is mostly wrong. All right? And that's why being contrarian works so well. As long as, again, what you're trying to do is find a stock that you want to buy at a level you want to buy it, and let everybody be contrarian against it because it's coming right to where you want. All right? And of course, again, we go back to compounding because that's a huge part of this model. Long-term investments, stocks, mutual funds, ETFs, muni bonds, tax-frees, treasuries, alternatives, and real estate. Those are all good. There's nothing wrong with doing any of this. Now, I'm assuming that most of you have either stocks or mutual funds anyways. You may have some bonds. Alternatives, maybe, but real estate. So the question would be alternative. And what would be an alternative? Well, alternative would be gold. Alternative would be cryptos. Alternative would be an investment that you may made with a hedge fund or something else that had, that was buying some things that were liquid, more like the endowment model that a lot of the universities use. Those are fine. Okay, as long as you know what you're buying, they're all good. Setting goals and priorities. Right? What are my most important goals? I said, what's most important to you? That should help you decide the amount of money you want to invest, and that should decide to help you what you want to invest in. Do you have a specific timetable? So were you going to buy a house? Do you have kids that are going to college, or you just save you for retirement? What do you want to achieve first? Right? Again, these goals that you're going to make need to be attainable. Setting a goal that I want to invest $5,000, I want to make $1 million is not an attainable goal. It can happen, but you'll be more disappointed. One of the things about goal setting is setting goals that can be reached, that you can then reward yourself and move on to the next step. Can I afford to realize my goals all at the same time? Am I willing to make long-term commitments? Okay, these are all things that are important as you're building your trading plan. What risk am I willing to shoulder along the way? Now, in 08, for example, I'm sitting in my office. My wife comes into my office and she's crying. She shows me my statement. I go, so what do you want me to do about it? All right, I'm hedged anyways, but what's the big deal? I know it's going to come back. I know that I've invested in strong companies. I know that the markets are going to go up 9% year over year, and if they're all going to go broke, then we get a much bigger problem. I said, don't worry about it. And of course, obviously I was hedged anyways, but the point is that understanding where that break point that you're going to have. Maintaining your portfolio is the second part of this, and that's managing and maintaining how you want to set your budget, all right? So trading is a competition Investing is not a competition. There are no prizes for winning, but there are severe penalties for losing. Emotions have no place in investing. You're generally better off doing the opposite of what you feel you should be doing. So that's one of the things, this is one of the ruinations of having so much technology now. It used to be you didn't get the paper and check your stocks, and maybe once a week you'd look at them. It's like the Jerry Seinfeld episode where he was watching that stock and he bought a different paper, hoping he would get a different price. Don't look at your portfolio. Your long-term portfolio is simply long-term. If you look at it every day, you're going to give yourself a nervous breakdown. The only investments that you can buy and hold are those to provide income stream with a return of principal. And again, dividend-paying stocks are great to own. They help you compound your portfolio because you're buying shares, and you're buying shares high, you're buying shares low, but you're always buying. Market valuations are very poor market timing devices. And again, valuations are a waste of breath when you talk about them. Now, again, I'll say something about them like when I'm on air because they're making me talk about it, but typically I don't really care. Right now, in my opinion, the market is overvalued. The valuations have not been this bad since 1929, if we all remember what might have happened then. Fundamentals in economics drive long-term investment success. Greed and fear drive the short-term trading. What do we see right now? We've got a market that is loaded up with greed and complacency because everybody knows that this time is different and the market's never going down again. Okay? Market timing is impossible. Okay? Managing exposure to risk is both logical and possible, which is correct. Investment is about discipline and patience. Lacking either one can be destructive to your investment goals. If you're going to, like I said, if you're going to look at the paper, if you're going to be looking at your iPhone all day long, you're only going to create problems for yourself. All right? The media, except when I'm on, offers no value. All right? And believe me, when I tell you this, I watch movies, sports all day long. I don't watch the networks because they're not going to tell me something that's going to help me. Any news they're going to report is already in the market, and they're going to influence me with what I would call bad advice on either side of the market. You are investing basing on probability. So right now, again, I'm investing now as well. Markets are top. I don't like them, but I haven't stopped investing for my IRA. But I know the probability states that the market should probably have a little bit of a solve at some point here. Nothing works on every trade or all the time. But what we're looking at is a long-term model that will mathematically work over time. Investing is not a casino. There's no reason to take unnecessary risk. Don't take money out unless it's just something that you really need to do. Try to let it stay there and work. Okay? Tips and touts, again, these hot tips that you get from the cab driver or the caddy, okay, are not going to usually pay you off. Remember, I look at it this way. When somebody gives me a hot stock, I figure I've been the 1 millionth person who got that hot tip. Use your 401k. Free the bank. There are no higher yielding investments out there. Of course, unless Jimmy Carter gets back in office and then go back to the bank. Don't settle for a low return on your investment. Buy low expense mutual funds. Don't pay too many fees. Buy and hold, avoid commissions and higher taxes. Again, that's something that you, in your long-term perspective, you're looking to do those things. We're looking to cut these costs. We're not trying to be in and out of the market. We're trying to grow and build. What I call the circle of success, your goals, your objectives, and your retirement. How are you going to get there? So we're going to invest X amount every month. I've got this to start with. I'm going to invest X amount every month. How do I continue to increase that and grow that? Well, one of the ways is using dividends. All right. Again, I don't know how many people I don't know how many of you guys know of people that you know that never made a lot of money in their whole life, but when they retired or they died, and you found out, man, that guy had $5 million in the state, he never made more than $40,000 a year. Well, how do you think he did it? He put away money in the markets every single month. That's how you do that. All right, it's not a secret. Many people won't do that, but that's what happens when you continue to invest. You'll be surprised at people that you know, and you know they don't make a lot of money, but they do invest, all right, and they've been investing, and they don't get scared out at how much money they've accumulated by letting it compound over and over again. Now, you get paid the dividend. Again, I believe in again, reinvesting that dividend. I don't want it. I want it to go in. Now, again, some of you, you're getting to the stage where, you know, maybe your IRA has to be bought out. You have to take your minimum distribution. You want to take your dividends? That's no problem. Again, just depends on where you are in life. Now, dividends themselves, there's a date of record. There's a declaration date. The dividend comes out. And again, for those of you who may not know, the dividend is not free money. Okay, the dividend is a amount that they take out of the stock and pay you. You get it at a better tax rate, which is why Warren Buffett pays himself. He makes $13 million a year. 12.9 is it's $12,900,000 in dividend income. Okay, because of the tax basis. But and then the DRIP program, dividend reinvestment, they just do it automatically. It's a wonderful tool. Now, just some stocks, and again, these are not recommendations. These are just stocks that I look at and I actually do own, but, you know, they're all high dividend payers, right, that just continue to, you know, they're going to be around, in my opinion. You know, Phillips 66, General Mills, Aflac, Johnson & Johnson, John Deere, Grainger, they're not going anywhere. So if they pay good dividends and they're not going anywhere, then I can continue to stay in them. Now, on the other side of the coin, most of them are not going to explode to the upside either. They're going to grind higher, they're going to grind lower. But these will be some of the ones that people will run to when the market starts to get in a little bit of trouble. Long-term is simple, but not easy. Stock prices lie, dividends tell the truth. Now, many of us get sucked into these very big dividend-paying stocks. Now, there's nothing wrong with it. I own a bunch of them, okay? But why is the company paying a big dividend? Right? Well, think about it. They're paying a dividend, they're paying a big dividend because they need the money, they need the investment, so they have to entice you. What they're doing is they're building the price discovery model of the dividend is where can I get the most investors? Can I get them at 5%? Is it 8%? What's the number? That's why companies like Annaly Capital and some of the other second ground lenders, they need to pay a bigger dividend to get people to invest with them. That's what the dividend's about, and that's why some are very small and some are very large. It's, again, the smaller the dividend, typically the safer the company. Long-term investing is not buy and pray investing. Know what you own. Don't sell because of small gains. If you overreact, you're making a mistake. If you have a 401k, put as much as you can. If you're with a company and they do any matching, you want to take the maximum you can possibly take, okay? Even if they squeeze a little bit, you want to put the maximum, especially if they're matching it. If you're behind, see if you can use a catch-up plan. There are some catch-up plans that are available. And again, you have to be diligent enough to put the money away, but you can try to catch up. Money that has been put away should stay away. Pay yourself first. Take advantage of every rule you can. To take advantage of the power and concept of compounding, you need an initial investment, earnings, dividends, interest, reinvestment of earnings, and time. Keep a long-term perspective. Don't panic when the market falls. Don't let tax considerations determine your strategy, which is why many people, you know, when Apple was 700, they didn't want to sell because they didn't want the tax implications. Of course, when they got to 350, they'd have been happy to sell and been rebuying it. But again, that's what I'm talking about. You can't outsmart the market by timing trades. The market can be fooled, but eventually the market is always right. Now, if you diversify, you look to diversify into different types of companies, maybe different sectors, maybe different parts of the world. That's up to you. Me personally, I do very little out of the country investing. I'm pretty much a USA guy. Okay, I'm not looking for a lot of things out there. You know, I hear them talk about it all the time, but I'm not a big emerging market guy. I'm a pretty much meat and potatoes. You know, I can invest in the New York Stock Exchange. That's enough for me. Investing is not gambling. Again, It's the second time this has come up because it's important for you to understand. Assessing your current financial conditions, your personal balance sheet, your personal income statement, relationship between the two statements, addressing your current positions. All right, that's what you got to figure out where you're at, because you need to budget out to make your goals. This is one of the things I always whine about and complain about the government, is if we lived like they did, we would be in jail or bankruptcy court. But here, you establish your goals of what you need and what you're looking for. And remember, if you're doing it on a tax-free basis and you're doing it with pre-tax dollars, you want to do as much as you can. Risk return and taxes. Okay. Providing needed liquidity. You got to make sure that you're liquid. All right. You have to have your assets. They don't all have to be liquid, but you always need something liquid just in case. Maybe you put away X for an emergency, and you got a bigger emergency, so you need something that's liquid that it's not like a panic to sell it. Quantify your investment goals. As always, we need to make sure we know where we want to go, and then protecting all that. There are ways to do that. Now, I love the story of Larry Page and Google. About 7 years ago, I think it is, Larry Page sold a big slug of his position in Google. And everyone was worried, oh my God, Google's there's problems. And after he sold it, he said, Google's great. I love Google, but it's 80% of my net worth. I can't afford to hold that. And I said, hey, Larry, if you'd have known me, baby, you could have held it all, because you could have just hedged what he had. But that's something that's important, that we don't ever want one stock, and most people have that problem, that one stock, an Apple or Google, maybe an Amazon now, that is worth more than most of their portfolio. You need to protect it, or you do need to sell it. All right? Many markets and large endowments have a process to help reduce risk, and of course, they do it more by rotation, but we actually have a hedging model that teaches you how to use options against your portfolio to create your own, basically called your own ETF, that protects the nuts and bolts of your portfolio for very little risk. And it's something that everybody needs to consider, because then you don't get panicked when the markets do crazy things. So if you hedge your portfolio using stock options, all right, or buy put options like credit spreads to finance the puts, that's kind of what you're trying to do. You want to finance as cheap as you can, and you want to hedge for as little as you can, but you also want to make sure that your core or your anchor money is protected. When the market goes down, you roll down your put options and you buy more stock. That's the key. That's how you compound. All right? The reinvestment compounds your portfolio with little to no risk to your initial investment. And basically, you can, depending on how you're doing it, you can cut your risk down to 2 to 3%. Now, if you look at the effectiveness of hedging, again, these are theories of models that we've run, but when you look at these models, okay, you can see that average portfolios will grow. And what do we all know? We know the market's rather soft. So if I'm in a position to buy the markets when they're selling off, and I can hedge when they're rallying higher, okay, what am I doing? I'm really selling tops and buying bottoms. Now, again, we're not trying to do that, but what we're basically doing now is we've turned our portfolio into a mathematical equation, and we're going to allow the math to work. And of course, using that strategy, we see these two big drops. Those are a chance to buy bottoms and sell tops. Again, it's something that you need to really seriously consider, because that will take out the fear, that will take out your wanting to ever puke out your portfolio, as they like to say. Match your investments to your goals. Spread your eggs among multiple baskets. Don't try timing the market. Set up a purchase plan and stick with it. Have a schedule, keep records, and keep reassessing your overall portfolio. Now, here's some basic stocks. Again, none of these are recommendations, but this is some of the stuff that I own and some of that you look at, and this is what you're trying to do when you're looking at your overall portfolio. Again, you want to put yourself, there's nothing wrong with taking a shot on something, but make sure that it's something that you can afford should it not work. Like I interviewed a guy a couple weeks ago, he's a penny stock trader. I go, I don't trade penny stocks, but I bought a bunch of them just for kicks because I could afford to take a little bit of a gamble. But your core should always be protected. That's what you're looking to do. You're looking to build a core of strong stocks that will build and compound over time. And everybody always wants to know, do they need a financial advisor? That's up to you. Again, even if I have a financial advisor, which I don't have an advisor, but I have my money with somebody, if he's going to do something, he's got to run it by me because I know what I've got and I know what I want to do. And if he has an idea, I will listen to the idea, but everybody should have an understanding of what they have and what they're trying to do. You should never depend totally on somebody else to take care of your money, because remember, nobody cares more about your money than you do.